On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets.
Hi all, hope you're well. Hope everyone has enjoyed their weekend. If you are in the upper half of the North Island, you will obviously have an extended weekend with a public holiday for you on Monday, so make sure you make the most of that. Let's look back at last week across financial markets, and then we will turn our attention to what's coming up in the days ahead. Last week was a good one for most share markets. The S&P 500 index in the US posted a 1.1% gain. That index obviously hit a new record high in recent days, surpassed the previous peak from January 2022, and that strength has continued as inflation figures and economic indicators have added to confidence that a soft landing might be able to be achieved in the US. There was strength elsewhere as well. European shares surged 3.2% last week, the UK up 2.3%. The Aussie market gained 1.8% and emerging market shares were up 1.5%. So strength across the board. The only region that did buck the trend was Japan, which fell by about 0.5%. However, Japan has still been the best performer so far this year. The Topics Index in Japan up about 5.5% year to date. And Japan was obviously the star of 2023. With share markets over there rising, I think it was close to 30%, wasn't it? Even outpacing the mighty US market. So Japan has been going very, very well for investors. The local market had a good week last week too. The NZX 50 posting its best weekly performance since early November and gaining 1.8%. Interest rates were little moved. The US 10-year Treasury yield hardly moved at 4.14. The domestic 5-year swap rate here in New Zealand steady at just below 4.4%, so not a lot of change there. Oil prices did jump about 6% last week. They finished at a 10-week high at about $78 a barrel, 78 US dollars. I think that came on the back of some solid US economic data. We had the GDP report for the December quarter, better than expected, pointing to a resilient US economy. And there was also some news of policy stimulus in China. So that raised hopes that you might see improving demand from the world's two biggest economies. Let's look back at some of the key releases, and locally, I guess it was the inflation report for the December quarter that took centre stage. The rate of CPI inflation, consumer price index inflation, fell to an annual pace of 4.7%. So that's good. That's the lowest we've seen since June 2021, and it was below Reserve Bank forecast for 5.0. It was in line with market forecasts, but good news nonetheless. The less good news was that when you look at the detail, it was really international factors that led to most of that decline. Domestic pricing pressures still tracking quite high. So you had what they call the tradables inflation lower than expected. That's all the international stuff, the imported stuff. But you had what they call the non-tradables inflation, which reflects domestic price pressures, still running pretty hot. That came in at 5.9%, which was actually above expectations. So I think that will still cause a little bit of concern for the Reserve Bank. Financial markets still see a good chance of an official cash rate cut in the not too distant future. In May, that's priced in to the tune of about 60%. I think most of the economists still believe that we might have to wait a little bit longer. Most of the economists have August in their numbers. So that was the key release in New Zealand, and it was good and bad. The inflation report. In the US, we also had some inflation figures. We had the Personal Consumption Expenditures Index, the PCE inflation report. This is the one that the Federal Reserve watches most closely, and so that's why it's one of the more important ones. very good news on this front. We saw the annual rate of headline PCE inflation slow to 2.9%. So, yep, that's right. It's got a 2 handle now. That's well down from the peak, which was north of 7 back in 2022. It's the lowest we've seen in almost 3 years. Core PCE inflation, that's running at an annual rate of 2.6%. So that was unchanged from last month, but it's still the equal lowest since early 2021. So let's just put that in perspective. You have got the most important inflation measures in the US that the Federal Reserve watches most closely, both with a 2 handle. At the headline level and at the core level. So that's very good news. And if you just look at the last 6 months and you annualize the average of the last 6 months, and the reason why I would do that is to just try and target that more recent trend rather than looking at what's happened over the last 12 months, because things have changed from where they were at 9, 10, 11, 12 months ago. So 6 months PCE inflation, you can annualize the average there, and it would be running at 2% at the headline level and 1.9% at the core level. So that's very good news. We also had some growth indicators out globally. I mentioned that strong US GDP report. We also had the flash PMIs for January, and that stands for Purchasing Managers Indices. These are very timely. They give us a very good read on what is happening in the here and now. So this is one of the first indicators we've had for the new year, and they did point to a more robust start to 2024 for most of the major economies. The US PMI rose to a 7-month high. Japan and the UK also solid and pointing to expansion. Those were the highest in 4 and 7 months, respectively. Europe and Australia still a little bit sluggish, although both did show improvements, and there were some mixed indicators on the inflation front, but generally things moving in the right direction. So that was good too. On the central bank front, we had a couple of central banks releasing monetary policy decisions last week. We had the ECB, the European Central Bank. They held firm, left their policy rate at 4%. That's the highest since the euro came into being in 1999. But we have seen some good progress on inflation in Europe. The headline inflation rate fell to 2.9% in December. That peaked at almost 11% in 2022. So that's come right back. And the ECB did acknowledge this. They did reference that declining trend in underlying inflation. So it does look like rate cuts are on the horizon, even though we didn't get one last week, and ECB President Christine Lagarde didn't want to talk about rate cuts. But the next decision from the ECB will come in March. And that's not seen as a time for a rate cut either, but the following meeting after that, April, seen as very likely. So it does feel like the prospect of interest rate cuts in many parts of the world has increased. So April, that's where people are thinking for Europe. The Bank of Japan also had a monetary policy meeting last week. They left things unchanged. Their short-term policy rate is still in slightly negative territory, and they still have this yield curve control program in place, which is where they are trying to control sort of interest rates in a longer term sense. So they're very much the outlier. The next move for the Bank of Japan is probably to start increasing interest rates, taking them out of negative territory and sort of starting to unwind some of that yield curve control that is also in place to keep longer term interest rates, such as the 10-year Japanese government bond, JGB yield, sort of anchored at low levels. So that's something we're watching from the Bank of Japan. And while that won't happen immediately, I think it will happen later in the year. The Bank of Japan next meets in mid-March, but again, it's the April meeting that many financial market participants see as the more logical opportunity for any changes to be made. That will be after the annual spring wage negotiations have happened in Japan. That's why April looks more likely. Right, coming up, plenty going on this week, lots to watch. We will get the first Federal Reserve decision of the year. That will be the unambiguous highlight. globally, and the outcome of this meeting is due on Thursday morning, I should say, Thursday in New Zealand at 8 a.m. Then we will get a press conference with the Fed Chair Jerome Powell too. So the Fed is at 5.5% in terms of their Fed funds rate. That's the highest since 2001. They're done. There's no more hikes from here. It is a matter of when do they cut. Their last set of forecasts suggested we will get 3 rate cuts this calendar year, 2024, although financial markets see double that this year. And the March meeting is seen as one potential opportunity. Pricing suggests a 50-50 chance of a rate cut then. If they don't do it then, in the eyes of financial markets, it will certainly come soon after that. So from the Fed this week, we'll be looking for any further commentary around the timing of that first rate cut and any insights into how they see current market expectations, particularly in light of those weaker inflation numbers. You've got inflation that's running in the twos now, so they're very close, if not at their targets. Are they going to do anything about that? I think they should. The Bank of England will also hold its first meeting of the year. Like the Fed, no changes expected there. They're seen as having reached the end of their hiking cycle, and it's just a matter of when do they cut. They're at 5.25, so not far off the Fed, not far off the Reserve Bank of New Zealand. Current pricing points to about 1% of rate cuts in total this calendar year. So going from 5.25 to 4.25. So we'll just wait and see what they say and whether they make any comments that sort of change the market's thinking on that front too. Also, lots of growth indicators coming out of the US. We've got the ISM Manufacturing Survey, the Institute of Supply Management Survey. This will be the manufacturing part of that that report. The services part will come next week. The manufacturing sector is still looking a little sluggish in the US, so we will be looking for any indications that things have stabilized or improved on that front. And we'll also get the first jobs report of the year, the January non-farm payrolls report. That is out in the US on Friday. So that will be closely watched, obviously, given the importance of the labour market for the path of the economy. Where is the unemployment rate sitting? I think it's sitting at 3.7%, isn't it? So it's expected to tick up slightly to 3.8 for the month of January. That would still be very low. I think to have unemployment below 4%, when you've got inflation, back pretty close to target, and when you've managed to sort of hold the economy together, that is a very good outcome if the unemployment rate can stay at those levels. So the market is expecting 175,000 new jobs to have been created, and that unemployment rate to just tick ever so slightly higher to 3.8. On the local front, we have the ANZ Business Outlook Survey for January. This will be the first edition of 2024. That's due on Wednesday afternoon. So back in December, we saw another strong rise in sentiment. The headline confidence measure rose to the highest since 2015. Own activity, which is the one that I watch, that's a much more useful leading indicator for economic activity and where growth is going. That also increased too. So that's sitting at the highest since June 2021. I think that has increased for, let me just double check that. 3 months in a row. That's risen for 3 months in a row. So that's positive. Part of that might be a reaction to the new government. So we'll wait and see if that sort of honeymoon optimism wears off, or if businesses are indeed continuing to feel better about the future. We'll also be watching for any inflation indicators, because although confidence measures have increased of late, inflation indicators in this survey have been less encouraging. You're still seeing some of those future signals about where prices are going remaining elevated. So that's something we need to keep a close eye on, particularly in light of the high non-tradables inflation that we saw in that report from last week. There will be other things to keep an eye on too. You have got fresh inflation and GDP readings coming out of Europe. We've got some unemployment figures in Japan. We will have the January PMIs out of China. We've got the flash PMIs for those other regions, like I just mentioned last week, but the Chinese ones always come a week later, so we'll get those this week. And across the Tasman, we will have the inflation report, the CPI report for the December quarter. So there are those bits and pieces to watch too. And the international earnings season. It'll be a very busy week of international earnings releases. So far, we've seen about a quarter of the S&P 500 report results, and it's been pretty good so far. 78% of companies have beaten earnings estimates. About 50% have beaten revenue forecasts. So been a bit of a mixed bag. You had the likes of Netflix that released a really strong result last week. Then you had Tesla at the other end of the spectrum, which wasn't so well received. But plenty to watch this week. Dozens of companies. I think about 75 S&P 500 companies scheduled to announce results, but it is some of the real heavyweights. You've got a lot of big tech names reporting results. Alphabet, that's the owner of Google, Microsoft, Amazon, Apple, Meta, which is the old Facebook, all of those companies reporting. So it'll be very exciting to watch, and plenty of other big names from other sectors too. Diageo, they're not a US company, but still a very high quality, very well owned and widely followed consumer staples business from the other side of the world. And you've got Starbucks, you've got Boeing, you've got ExxonMobil. I think we've got MasterCard as well. So there is no shortage of businesses to watch and earnings releases to ponder. So it'll be a busy week. The other thing that's probably worth a mention on the Reserve Bank front here in New Zealand, the Reserve Bank Chief Economist Paul Conway is giving a speech on Tuesday morning at 9 o'clock. If you're really keen, you can watch that online and live stream it. So that, I think, will get a bit of attention as well, because we haven't heard from the Reserve Bank since back in November. And since then, here in New Zealand, we've obviously had that very weak GDP report that came in December, and you've had weaker inflation, and you've had strong markets that have risen on the back of optimism globally for interest rate cuts coming more quickly than many people would have thought 3 months ago or 6 months ago. So because we haven't heard from the Reserve Bank in a while and market expectations have shifted quite aggressively, I think that speech will be closely watched. I'm not sure he'll give anything away. I think it's too early, personally, for the Reserve Bank to change tack. I do believe they'll change tack, but I think that will come later in the year. So I would still expect them to remind us of some of the risks out there, remind us that there are still some inflation pressures, and maybe the tone will be of don't get ahead of yourself, team. We'll have the next Reserve Bank monetary policy statement at the end of February, but this speech will be interesting because it will fill the gap to a degree. Because between last November and late February, a lot can change. So that's something else to keep an eye on. All right, team, thank you for listening. We will leave it there, and we will talk again very soon.